Well, it's that time of year where you probably aren't packing stock analysis reports for your beach reading or busy scheduling time with your financial advisor. So you may be missing out on some of the surprising trends in the market this summer and signs of what's ahead. Well, despite all the troubles in Europe and concerns about growth in China, the leading index for international developed markets shows those stocks are solidly outperforming the S&P 500 so far this year. So is it time for a mid-course correction in your investing? To save you more time for the sand, we're bringing the financial analyst to you. And Triana, President and CEO of Curo Private Wealth, is here quarterly to enlighten us on what to expect in the months ahead. And she says there are some surprises in the marketplace right now. And talk about first the developed nations. How is it that they can be so solidly outperforming the S&P 500? We've been told run, don't walk from European stocks and worry about China.
Right, exactly. Well, I think part of the issue is last year we substantially outperformed the developed international markets, so it may be an issue of our markets getting a little bit expensive and the European markets getting a little bit cheaper. They're also about to go into quantitative easing. Don't fight the Fed was the big trend here in the U.S., so I think that's probably going to continue overseas.
But don't always just read the headlines. You've got to look deeper than that, because now if you want to see the gains, it's what are the current numbers for the international developed markets compared to the S&P?
So international developed is up as of Friday, year to date about 8%. In the U.S., S&P is up about 3% year to date as of Friday.
So you say there are some important numbers here that we want to take a look at. So let's start with interest rates.
Okay.
What is your crystal ball telling you?
So there's a lot of talk about interest rates right now, but the questions are, when is the Fed going to increase, by how much? And the most important question I'm hearing is, will that cause us to stop this bull market, right? We're more than 6 years into this bull market, and that's the key question.
People are buying houses and all kinds of things that could be impacted.
Right,
so
exactly.
What's the answer?
We've talked about the yield curve before. It still looks very positive. We want to pay attention to when it inverts. When short-term interest rates go above long-term interest rates, that is a warning sign, and so far it is nowhere on the radar screen.
So a green light from you on interest rates. Let's talk about the LEI, the leading economic indicators. That's another number that you're always telling us is important.
My favorite, right? My favorite economic indicator. Latest data that we have from May is that the LEI was up 0.7%. That's a solid increase. Year over year, it's sitting at positive 6.2%. Really important. What this means is the probability that we may go back into a recession in the next 12 months sits at only 4% right now. Now, this is when I say past performance doesn't guarantee future results, and 4% is not zero, certainly, but 4% is pretty low.
And we're certainly not firing on all cylinders, but there has been a lot of concern about another recession. So you say right now you rate that a very low probability. Stock valuations, another thing you're always teaching us to read between the lines. What are you seeing there?
Yes, so last time I was on, valuations were one of the indicators that was on watch. They still are on watch. They're actually higher than they were last time I was on. So the long-term PE ratio on the S&P 500 is 15. We're at about 20, just over 20 as of Friday's market close. It went on watch when we went above 17. So definitely one of the 5 major recession indicators we track that is on watch. However, I want to remind people that the PE ratios can be elevated for extended periods of time in low interest rate environments, which we are definitely in right now.
So it seems like you say it's a time to buy. Anything else that you're looking at? We're looking for quarterly earnings reports coming out.
Yeah,
what are you seeing there?
So Q2 earnings have started. I'm hoping that this will take the focus off some of the more emotional issues like Greece and Europe and Puerto Rico and the slowdown in China, and back to fundamentals, right? How are U.S. corporations actually doing? And I have to tell you the bar is very low. So Thomson tracked consensus earnings. Consensus is asking for a 3% or expecting a 3% decline in earnings. So I think if we can get a little bit of a positive upside surprise, that could be the catalyst that can push us out of this range we've been in and into some growth over the next half of the year.
Good advice, and don't just focus on the media headlines.
Yes,
And
exactly.
Triana, thanks as always for joining us on Washington Business Report.